$83.50. December 29th, 2025, silver just touched its all-time high. For about 3 hours, then $71. A 14% wipeout in less than 24 hours. 165% gains for the year, gone in a blink. And the question everyone's asking is the same question they always ask after the euphoria ends. Is silver dead? Here's what nobody's telling you. This wasn't a natural correction. This wasn't profit taking. This was Silver Thursday 2 in a row. And if you don't know what Silver Thursday means, you're about to learn why history doesn't repeat, but it rhymes. And right now, it's rhyming with March 1980. Let me show you exactly what happened on December 29th, why it happened, who made it happen, and why the answer to whether silver is dead depends entirely on whether you're holding paper or metal. Because there are two silver markets right now, and they just violently divorced. December 26th, 2025. Christmas had just ended. Silver was trading near $83. The year had been extraordinary, from $28 in January to over $80 by December. That's not a rally, that's a moonshot. And everyone knew something had to give. What they didn't know was when or how. Then CME Group, the company that runs COMEX, the exchange where silver futures trade, dropped advisory number 25393. Effective Monday, December 29th, initial margin requirements for March 2026 silver futures would jump to $25,000 per contract. That's up from $22,000, a 13.6% increase. And here's the part that matters. This was the second margin hike in less than 2 weeks. Let me explain what this means in simple terms. When you trade futures, you don't pay the full price. You put up margin, a fraction of the contract value. That lets you control large positions with relatively small capital. It's leverage, and leverage works both ways. When prices go up, you make money fast. When prices go down, you lose money faster. A margin hike means you need more cash to hold the same position. If you don't have it, you're forced to sell. And when everyone is forced to sell at the same time, that's called liquidation. And liquidation creates crashes. So CME raised margins, not once, twice in 14 days. By December 29th, the cost to enter a silver futures position had effectively tripled compared to early 2025. For retail traders, for smaller institutions, for anyone using leverage, this was a kill shot. Sunday night, December 29th, markets in Shanghai opened first. The Shanghai Futures Exchange, which has increasingly become the real price discovery mechanism for physical silver, not COMEX. The opening was brutal. Silver gapped down to 18,728 Chinese yuan per kilogram. That translated to $73.72 per ounce, from $84 to $73 in minutes. Over $10, 12%. Then the selling accelerated. Leveraged long positions, traders who'd borrowed to buy silver, got margin calls. Sell now or we sell for you. And they sold. The price kept falling. 73, then 72, then 71. By the time New York opened, silver had lost 14% of its value. Over 67 million ounces in paper contracts were liquidated, not sold, liquidated, forced. This is exactly what happened March 27th, 1980, Silver Thursday. The Hunt brothers, two Texas billionaires, had tried to corner the silver market. They'd bought so much silver, over 100 million ounces, that they controlled about 1/3 of the world's supply. The price had rocketed from $6 to $50 in a year. Then COMEX changed the rules. They implemented Silver Rule 7. They raised margin requirements. They restricted purchases. They forced liquidation only. The Hunt brothers couldn't meet the margin calls. Silver crashed from $50 to $10 in 2 months. The brothers lost over $1 billion. Their empire collapsed. And the lesson was simple. When the exchange changes the rules mid-game, the players with leverage lose. Always. Fast forward 45 years. December 2025, different players, same playbook. CME raises margins, forces liquidation, prices crash. Except here's the difference. In 1980, the Hunt brothers were trying to manipulate the market. In 2025, the rally was driven by something else, real industrial demand. And that changes everything. Let me show you what's actually happening beneath the surface. Because the crash tells one story, the fundamentals tell another, and the divergence between them is where the truth lives. Throughout 2025, silver's industrial demand hit levels never seen before. Solar panels, electric vehicles, AI data centers. These aren't speculative bubbles. These are structural shifts in how the world generates power, moves people, and processes information. And all of them need silver. Solar panel production alone consumed over 230 million ounces of silver in 2024. That's expected to hit 300 million ounces by 2030. Why? Because silver is the best conductor of electricity at room temperature. Nothing else works as well in photovoltaic cells. You can try to substitute copper or aluminum, but efficiency drops. And when you're trying to power the world with sunlight, efficiency matters. Electric vehicles use 25 to 50 grams of silver per vehicle. That's 2 to 3 times more than internal combustion engines. Battery management systems, power electronics, charging infrastructure, all silver intensive, and global EV production is projected to more than double by 2030. That's not hype, that's policy. Governments around the world have mandated the transition. The demand is locked in. AI data centers are the new wild card. Every data center processing AI workloads generates enormous heat. Silver's thermal conductivity makes it essential for cooling systems. And as AI infrastructure expands, silver consumption increases. Some estimates suggest millions of additional ounces annually just from this sector. Add it all together. Industrial demand in 2024 reached 680 million ounces, a record. And 2025 is projected even higher. This isn't speculation. This is documented consumption. Silver being used up, not recycled, not returned to the market, consumed. Now, here's where it gets interesting. While industrial demand surged, mine production didn't. Silver mine output has been declining for years. The Silver Institute reports that supply has dropped about 7% since 2016. Why? Because silver isn't usually mined directly. About 70% of silver comes as a byproduct of mining other metals: zinc, lead, copper. So silver supply is dictated by demand for base metals, and base metal prices have been weak. No new mines, no new supply. This isn't speculative demand that disappears when prices spike. This is industrial consumption that has limited substitution options, because silver's electrical conductivity is unmatched. You can't make solar panels as efficient with copper. You can't make electronics as conductive with aluminum. Silver works because of unique physical properties that can't easily be replicated. And the third force? Investment demand. This is where today's volatility actually lives. Investment demand is inherently more volatile than industrial demand because investors can change their minds quickly. They can take profits. They can get scared. They can chase other opportunities. And that's exactly what happened today. But let's put it in context. Global silver ETF inflows hit approximately 200 million ounces in 2025, way above earlier forecasts of 70 million ounces. Central banks globally have been buying over 1,000 tons of gold annually for 3 straight years, signaling concerns about currency stability and geopolitical risks. Silver, as gold's more accessible cousin, attracts similar safe haven flows, but with a much smaller market that amplifies price moves in both directions. So when you combine structurally tight physical supply, growing industrial consumption that can't easily be turned off, and surging investment demand from both retail and institutions, you get the setup for exactly what we've seen: an explosive rally that periodically needs to relieve pressure through sharp corrections before continuing higher. Now, let's talk about what the technical charts are saying, because this matters for understanding what comes next. Silver's 14-day relative strength index, the RSI, has been above 70 for weeks. That's the traditional overbought threshold. In fact, according to market analysis, silver's RSI hit 90 at certain points in December. That's extremely overbought by any standard measure. But here's what most people misunderstand about overbought conditions. Overbought doesn't mean the rally is over. It means the rally has been strong and might need to consolidate before continuing. During the 1979 to 1980 silver mania, the RSI stayed overbought for months, while silver went from $6 to $50. During gold's 2008 to 2011 rally, gold stayed technically overbought for years, while gaining 166%. Silver gained over 400% during that same period. Markets can remain overbought far longer than conventional technical analysis suggests, especially when driven by fundamental forces rather than pure speculation. And that's the key question. Is silver's 2025 rally speculative froth or fundamental repricing? The answer is probably both, but with the fundamental story providing the foundation. One technical pattern getting attention right now is what analysts call a closing price reversal top. This happens when a market makes a new high, but closes significantly lower than the high, suggesting buyers are losing control. Friday's session saw exactly that. Silver hit new records, but closed well off the highs. Then today, his overnight spike to 84, followed by the collapse to 75, creates an even clearer reversal pattern. According to technical analysts, this doesn't necessarily signal a trend change. It signals that the market needs to alleviate upside pressure. Translation: prices got ahead of themselves in the very short term and need to consolidate before potentially moving higher again. The key level to watch now is Friday's close around $79. If silver holds above that level on a closing basis, the bullish structure remains intact. If it breaks below and stays below, we might see a deeper correction toward $70 or even $65. But let's zoom out for a second, because getting lost in daily volatility can make you miss the forest for the trees. Silver started 2025 around $30 per ounce. Even after today's pullback to $75, that's still a 150% gain for the year. Pulling back 10% after being up 165% isn't a crash. That's a normal, healthy correction in a volatile asset during an extended bull run. And here's something most coverage is missing. The fundamental drivers that powered silver from $30 to $84 haven't changed because of one day's price action. The supply deficit is still there. The industrial demand growth is still there. The geopolitical tensions supporting safe haven flows are still there. The Federal Reserve is still expected to cut rates in 2026, which typically supports precious metals. The dollar has been weak, which helps silver. What changed today was short-term sentiment and positioning. Traders took profits after thin overnight liquidity pushed prices to extremes. That's it. That's the story. Not some fundamental breakdown. Not some new supply source appearing. Not industrial users finding miracle substitutes. Just profit taking after an incredible run. So what happens next? Well, nobody knows for certain, obviously. But we can look at what history and market structure suggest. After sharp corrections during strong bull markets, assets typically consolidate, form a base, and then attempt to move higher again if the fundamental drivers remain intact. Silver in 1979 to 1980 had multiple 15 to 20% pullbacks on its way from $6 to $50. Gold from 2008 to 2011 corrected 15 to 25% several times while making higher highs. The question isn't whether silver will have volatility. Of course it will. The question is whether the structural setup, tight supply, growing demand, supportive macro environment, supports higher prices over the next 6 to 12 months despite short-term swings. And most analysts focusing on fundamentals rather than daily charts think it does. Bank of America has a 12-month silver target of $65, which we've already exceeded. Some analysts, like Peter Krauth, suggest $95 over 12 to 24 months based on structural deficits and gold-silver ratio reversion. Longer-term projections through 2030 from mainstream sources range from $80 to $100 per ounce. More optimistic forecasts suggest triple digits if supply constraints persist and industrial demand accelerates. Which scenario plays out? Unknown. But the setup is in place. Tight physical supply, high industrial demand, export restrictions, and a paper market that just proved it will change the rules when threatened. That's not stability, that's fragility. Now let me tell you what this means for you. If you were long silver futures with leverage, you learned an expensive lesson. Exchanges can change the rules. Margin requirements can spike. Forced liquidation happens. This is why leverage is dangerous. You can be right about the direction and still lose everything if you can't survive the volatility. The Hunt brothers learned this in 1980. Countless traders learned it December 29th, 2025. The lesson doesn't change. If you own physical silver, you're in a different position when you watch the paper price crash. But your metal didn't vanish. You didn't get liquidated. You're holding an asset that's still fundamentally scarce, still industrially essential, and still trading at premiums in the world's largest consuming market. The question is whether you have the conviction to hold through volatility. Because this won't be the last time paper markets and physical reality diverge. If you're thinking about buying silver now, understand what you're buying. Paper or physical. ETFs like SLV are paper. They track the price but don't give you metal. Futures are paper, leverage, and risk. Physical coins, bars, allocated storage, that's real metal. And in a world where Shanghai trades $8 above New York, physical matters more than paper. The crash exposed the system's pressure points. COMEX can manipulate prices through margin hikes. That's not conspiracy. That's documented fact. They did it in 1980. They did it in 2011, 5 margin hikes in 9 days causing a 30% drop. And they did it again in 2025. The mechanism is known. The results are predictable. Paper crashes, physical holds. But here's what margin hikes can't do. They can't create new supply. They can't reduce industrial demand. They can't make China export silver it needs domestically. They can't change the fact that solar, EVs, and data centers require silver. All they can do is temporarily suppress the paper price and hurt leveraged traders. So is silver dead? No, silver is scarce. The 165% rally in 2025 wasn't a speculative bubble divorced from reality. It was reality finally pricing in years of supply deficits, industrial demand growth, and structural tightening. The 14% crash on December 29th wasn't reality reasserting. It was a paper market mechanism designed to prevent a short squeeze that would have exposed how little deliverable metal actually exists. The Great Divergence tells you everything. Shanghai at $78, COMEX at $71. That $7 to $8 gap is the price of real metal versus paper promises. And it's not closing, it's widening. Which price do you think matters more to a solar manufacturer who needs silver today? The futures contract price in New York or the spot price in Shanghai where they can actually buy metal? This is the same question that mattered in 1980. The same question that matters in every commodity market. What's the real price? Not the manipulated paper price, not the leveraged futures price. The price where physical metal actually changes hands. And right now, that price is materially higher than the paper price. That's your signal. The crash hurt. 14% in a day hurts. But crashes create opportunity for those who understand what they're buying. Physical silver under $75, when physical markets in China are paying over $78, when industrial demand is at record highs, when supply is in structural deficit, when governments are restricting exports, that's not a death signal, that's a recalibration. The 2026 question isn't whether silver rallies again. The question is whether COMEX can keep suppressing prices through margin manipulation while physical markets keep tightening. And history suggests that physical reality eventually overwhelms paper fiction. It just takes longer than traders with leverage can survive. So no, silver isn't dead. The 165% rally to $83 wasn't a bull trap. It was a supply-driven, industrially justified repricing that paper markets tried to stop through margin hikes. And they succeeded short-term, crashed the price 14%. But the fundamentals didn't change. The industrial demand didn't stop. The supply deficit didn't magically resolve. And the divergence between physical and paper prices is still screaming that something is broken in the price discovery mechanism. Silver Thursday 1980 destroyed the Hunt brothers. But silver itself went on to make new highs decades later. Silver Thursday 2025 destroyed leveraged futures traders. But silver itself, the physical metal that powers solar panels and electric vehicles and data infrastructure, that's not going anywhere, except into permanent industrial consumption. The crash exposed who was swimming naked, leveraged paper traders. The crash didn't expose weakness in physical markets. It exposed the opposite. Physical markets stayed firm while paper markets collapsed. That's not bearish for silver, that's bearish for paper. If you want to know what happens next, watch the premiums. If Shanghai keeps trading $7 to $8 above COMEX, if London physical premiums stay elevated, if delivery delays persist, that tells you the physical market is tight regardless of what paper prices do. And eventually paper prices have to follow physical reality, or paper markets become irrelevant. The CME can raise margins again. They probably will if silver rallies back toward $80. But every time they do, they prove they're afraid of the physical delivery obligation. And every time they prove that, more participants realize the paper market is a controlled mechanism, not a free market. And they shift to physical, which tightens physical supply further, which makes the next squeeze more dangerous. This is the trap exchanges find themselves in. They can suppress paper prices, but doing so accelerates the flight to physical, which makes the underlying shortage worse, which makes the eventual repricing more violent. They're trying to prevent a crisis, but their tools are causing the exact crisis they're trying to prevent. So here's the answer. Is silver dead? Ask yourself which silver. Paper silver got destroyed December 29th. Physical silver took a hit, but stayed fundamentally tight. If you're playing with leverage in futures markets, yes, you might be dead. But if you understand why silver matters industrially, structurally, strategically, you're probably viewing the crash as noise and the fundamentals as signal. And the fundamentals say the shortage is real, the demand is real, and the great divergence between paper and physical is the story of 2025 bleeding into 2026. History doesn't repeat, but it rhymes. And right now it's rhyming with 1980. The question is whether you learned the right lesson from that rhyme.